Hey everyone, welcome to Docs Investing Rx, the place to get a prescription for better financial health. I'm your host, Doc, and today we're going to take a deep dive into cake. Now, not little cake, though that sounds good, but a concept called the Chocolate Cake Theory of Investing. It's about the gap between what we know we should do and what we actually do when markets get spicy, scary, or seductive. Here's what we'll cover. Why do smart people make dumb investing moves? The psychology of FOMO, fear, and fake confidence. How to use chocolate cake framework to build habits that beat hype, and my favorite investing mistakes. Yes, mine. That taught me everything I now teach. Now, if you ever bought high, sold low, or stared at a stock chart like it was your ex's Insta feed, this episode is for you. Now, let's start here. You are not a robot. You're warm blooded, stress eating, non-stop feed scrolling, viral video watching human. So when it comes to investing, your brain is not built for long-term success. So here's proof. Studies show the average investor underperforms the market by 3 to 4% annually. Why is that? Well, emotional decisions, right? We panic sell. We do FOMO buying. We try to time the market. We try to chase trends. We all know buy low, sell high. But we feel buy what's going up and sell when we're scared. Trump's Liberation Day came and crushed the market. And it's scary. It's scary losing all that money. And people panic sold. But guess what? We bounced back and here we are. And it happened very quickly, too difficult to time unless you are paying very close attention to the market. Now, here's a fun truth bomb from the Oracle of Omaha, Mr. Warren Buffett. Quote, the market is a machine for transferring money from the impatient to the patient. Now, that's a very important thought, right? Your brain wants the dopamine now. It wants excitement now. It wants that chocolate cake. So let's break it down. The chocolate cake theory of investing goes like this. You know, salad is good for you, right? You know, long term investing is smart. But in the moment, when everyone's buying Tesla options or meme coins or that next big AI play, you cave. You don't eat chocolate cake because it's logical. You eat it because it feels good now. Same with risky stocks, hyped IPOs, or that sudden pivot into fart coin at 11 p.m. after reading one too many posts. So the rule is you can eat the cake, just not every day. You can speculate, gamble, YOLO trade, but only if it's a sliver, not the whole portfolio. It's about intention, not impulse. So let's break down the most common investing traps, aka the frosting on that financial cake. So FOMO, of course, the fear of missing out. You buy high because you're afraid everyone else is getting rich. Classic trap of getting left behind. There's loss aversion, right? Losses feel twice as painful as gains feel good. That's why people panic sell during dips. And then, of course, overconfidence. You think your stock pick is different. You think you read the chart, you know what's going to happen, you can see into the future. Or you may think that you have insider information that nobody else has, but guess what? You don't. How about recency bias? If something went up last week, we think it'll keep going. Or if something dropped yesterday, we think it's doomed. Confirmation bias. You only read articles or forums that say you're right. It's a dangerous echo chamber. So you got to recognize the emotional trap. Pause, take a deep breath, be a good patient, eat salad, not cake. But let's make this practical, okay? So your portfolio should have two sections. All right. So you have the salad, right? It's boring, it's balanced, it's healthy. This is your long term wealth. And the way I have it, I have a separate account for this, right? This is my broad market index funds. These are ETFs. These are my dividend stocks. This is where I like dollar cost average my high quality stocks. And for myself, these high quality stocks include Apple and Nvidia at the moment. Again, in a few years, this may change. Now, the cake. This is the fun part, right? Now, again, I have a separate portfolio for this stuff. This is the individual speculative or what I call lotto stocks, right? This is also maybe you have a section for crypto. Maybe you have sector plays or leveraged ETFs, whatever gets you excited, but it's dessert, right? This is not dinner. So, this is my pro tip to you: limit the cake to 10% or less of your portfolio. That way, if it goes to zero, you still have the nutrition to keep going with those great broad market index funds, doubling your portfolio every few years. And usually, what I tell people is at least $10,000 should be put into these broad market index funds to start if you are beginning your investing journey. Now, what about me? This is where I spill the tea. My dumbest investing mistakes. Now, I have a lot, so I figured I'd share a couple with you. So, one mistake was buying the top of the squeeze. Now, everyone was hyping the stock called Sava, also known as Cassava Sciences. They were on the verge of coming up with a cure for Alzheimer's disease. Now, that's huge, right? So, I see the chart, and during the squeeze, it pulls back. So, I'm thinking, hey, I'm getting a discount on this thing. However, it continued to drop. Next thing you know, I'm a bag holder, and it's down 70% from when I bought in. No real revenue, no real business, just hype. And of course, it ended up being a flop. Fortunately, I finally pulled the plug on it before it dropped another 90% when they finally bailed on the whole drug. Now, mistake number two: panic selling. Okay, the year was 2018 and it's sort of right into 2019. Trump had kicked off the tariff wars round one during his first term, and the markets got rattled as the year ended. Now, I had a huge holding of Apple and Tesla, but they were getting crushed, right? I'm seeing my portfolio getting chopped by huge percentages because I was into these individual stocks. So as the market sold off, I panicked. I panic sold during the dip. Now, just to give you an idea, Apple was at the pre-split price of $34 and Tesla was at $18. Even worse was trying to get into Tesla calls as I was trying to revenge trade. But guess what? Tesla continued to tank to $12 over the next few months. It was a classic rookie move. Now, less than 7 years later, Apple is now at just under $200 and Tesla's at $320. Missed out on massive gains by destroying my portfolio. And that's all because I panic sold. Mistake number three was ignoring fees. Now, this one I learned pretty quickly, but I once bought into this mutual fund with a 2% annual fee. And if you think about it over 20 years, that's a quarter of your gains gone. That's insane, right? So, fortunately, I eventually moved it into a low cost index fund with fees less than 0.1%. So, what did I learn? First, have a plan, right? Automate the strategy with constant buying or dollar cost averaging because the stocks will continue to rise. Trust the time, not trends, right? The market will recover eventually. And we saw that again with Liberation Day. The markets tanked, but they recovered. Now let's zoom out a little bit because investing today is just not the same as it was back in our parents' time, right? Back in the day, there was no way to follow live stock prices, right? You would read them in the paper, make a phone to your broker. Next day, they plug it in and you're set. You bought blue chip stocks, maybe a house, and if you were fancy, you had a financial advisor in a beige suit named Bob. But now we live in an attention economy, right? Investing has become entertainment. Let me show you how distraction is the new hidden tax. Investing feels like a game, but it's not. You've probably seen apps that use confetti when you buy a stock. You get badges for completing your first trade. You can follow other investors like yours truly, or maybe some social media influencers. But guess what? That's not really investing. That's gamification, right? Robinhood, Webull, eToro, even newer platforms like Public, they're just turning your portfolio into a dopamine machine. And here's the danger. When investing feels like a game, we take it less seriously, but the consequences are still very real. So every headline feels like a signal, right? Let me say this loud for the people in the back. Not every headline is an investment signal. Markets react to news, but that doesn't mean you should. Remember when everyone sold tech stocks because of rising interest rates? Then AI stocks boomed, and suddenly everyone forgot the Fed existed. This whiplash makes people feel like they need to constantly adjust, right? What about these frequent portfolio changes? That's chocolate cake thinking. It feels good in the moment, but it wrecks you over time. Now, here's a fun comparison. Think about our parents, right? Or what people slang call them boomers. They bought in real estate, long term stocks, pensions. They played it boring, but they won big. Millennials, right? Hit by the 2008 financial crisis. Then they try to recover with crypto, startups, right? Side hustles, still trying to figure it out. And then you got Gen Z, right? Coming in during the TikTok investing era, you know, thinking about investing as option plays, NFTs, meme stocks. So who's right? Honestly, right? You think about these quote boomers being boring, but boring worked because boring equals compound interest, low fees, time in the market. Boring equals wealth. If you're on the younger side and listening to this, start investing like you're 60, even if you're 26. You'll thank yourself later. All right, so let's give you the winning recipe, okay? I call this sort of the two fund portfolio. This is let's call it the kale smoothie of investing. It's not sexy, but it's powerful. All right, it goes like this. As I mentioned before, try to focus on taking that first $10,000 and investing it into like a total US stock market index fund. And if you want a portion of it into a total international stock market index fund. And that's it, right? It's low cost, it's diversified, it's easy to automate. After that $10,000, you can just keep going and just focus on building up your portfolio with this boring index fund. Guess what? It'll beat 90% of actively managed portfolios over time. And for most of us, that's not bad. That's actually really good. And the best part, you'll have more time for cake when you know the salad is taken care of for you, right? You can take a little portion of your portfolio and go after the speculative plays. So I'm going to leave you with this thought here. The people really building wealth, they're not flexing rollies or Lambos or Twitter portfolios. They're not on TikTok saying this one stock will 10x in 3 months. They're playing defense, right? They're staying invested. They're buying the boring stuff and keeping quiet. Meanwhile, the loud ones, they're often chasing the next shiny object. And when the music stops, they're left holding the cake and the calories. So don't fall for loud. Build quietly, build slow, build smart. So here's a challenge for you. It's super simple, but crazy effective. Every time you want to buy a stock, make a note of why. Was it hype, boredom, a headline, FOMO? And don't buy it immediately. Can you wait 72 hours to buy this? If you can't wait 72 hours, then maybe this is an emotional play. So, with that, I want to leave you with something actionable. Take this prescription to improve your financial health. Repeat after me. I will not chase trends. I will not panic sell dips. I will invest in salad before I touch the cake. I will stick to my plan when it's boring. I will trust the process, not the headlines. All right, that's it. Investing is a test of patience, not prediction. It's about behavior, not brilliance. And the most successful investors, they're not the ones who call the top or the bottom. They're the ones who didn't quit in between. All right. Thanks for coming to my clinic today. No copay for this visit. But if you got value for this episode, share it with someone who's on the verge of eating the whole chocolate cake. Until next time, this is Docs Investing RX reminding you emotions come and go, but discipline always pays dividends. Take care.